Living in Greece is harder than you think. In 2017, buying a home in Athens would set you back around €1,300 per square meter. Today, that price has nearly doubled to 2,500, a staggering 88% increase in less than a decade. And it's not just Athens. In 8 years since 2017, property prices nationwide have risen by nearly 70%, faster than almost anywhere else in Europe. But wages haven't kept pace. The average salary has barely moved in years, and in real terms, many Greeks are earning less than they did before the 2008 crisis. This is more than just a housing problem. There is a cost of living crisis, a rental crisis, and now even an immigration crisis, though not in the way you might think. Because the real pressure isn't coming from asylum seekers or refugees, it's coming from tourists, digital nomads, and wealthy foreign investors. Today, tourism fuels over a quarter of Greece's entire GDP, and nearly 2 million Greeks, a fifth of the population, earn their living from it. But in Athens, short-term rentals like Airbnb have exploded, outnumbering local homes and driving up local rents in the process. Why rent to a Greek family for €500 a month when you could make the same in a week from a tourist? Entire neighborhoods have been reshaped, and with over 1 million short-term rentals nationwide, it's no longer just a city issue. In some areas, as many as 1 in 5 homes are either vacant, investor-owned, or reserved for tourists. Locals are either being priced out, pushed out, or forced into tiny apartments far from where they work. Many have had enough, and protests are becoming a common sight, and others simply haven't waited. Since 2009, more than 500,000 young, educated Greeks, doctors, engineers, teachers, have left the country entirely. But this problem runs deeper than housing, because the crisis is just one piece of a bigger picture, a slow-burning shift that threatens to redefine what it means to live, work, and belong in Greece. So how did it get to this point, and can anything be done to fix it? This is how living in Greece became impossible. It may seem like we're talking about this problem everywhere in Europe, but in Greece it's particularly acute because of another issue, which they became somewhat famous for: debt. To understand how the modern-day living crisis took shape, we need to quickly go back in time. In the 1970s, Greece had just emerged from a military dictatorship, and the new democratic government was eager to prove that prosperity was finally within reach. To do this, they spent big. Highways were built, hospitals expanded, and public sector jobs multiplied. People who had once lived through rationing could now count on a government salary or pension. It felt like progress, but there was a catch. Most of it wasn't paid for. Successive governments borrowed heavily to fund this vision, not just in emergencies, but as a habit. No one wanted to be the one to say stop. Public debt quickly piled up, more than tripling in the 1980s, and it just kept growing. At first, it didn't seem urgent. Economic growth was still steady, and besides, everyone else seemed to be doing it too. The UK, Italy, Belgium, they were all borrowing just as much as Greece was. But not all debts are equal. And unlike their neighbors, many businesses in Greece operated solely on cash. Tax evasion was easy, and it was rampant in the system. At the same time, wealthy Greeks often found loopholes to avoid taxes altogether, and what the government gave, it couldn't always replace. By the time Greece was prepared to join the Eurozone in the late 1990s, their debt had reached 97% of GDP. While today that may seem somewhat normal, in comparison, other healthy economies at the time, like the UK and Japan, were running on only 50% and 60% respectively. This level of debt is incredibly risky for any nation, but for one overspending and under-collecting, it was a ticking time bomb. But Greece stubbornly pushed forward, and in 2001, the country officially adopted the euro. For a while, access to cheap credit in the Eurozone completely masked the underlying issue of overspending. Interest rates stayed low, the money kept flowing, and so Greece kept borrowing. But then came 2008, the global financial crisis. After the US market crashed, investors worldwide began to panic, and everyone started pulling back their money from abroad. For a country dependent on borrowing, it was catastrophic. Suddenly, no one wanted to lend to Greece, and borrowing became nearly impossible. The reserves quickly ran dry, and they were out of money. Despite this, there was an even bigger problem. In the past, a country in a debt crisis could quickly devalue its currency to boost exports, or simply print more money to pay it back. But Greece had just joined the euro. It couldn't print more money, and it couldn't devalue its currency. It had no way out. The numbers were staggering. From 2009 to 2014, The economy shrank by more than 25%. That's not just a recession, that's a complete economic shutdown. And to this day, Greece's GDP still hasn't returned to pre-crisis levels. The unemployment rate shot to nearly 30%, and families who once felt secure saw their pensions cut, wages slashed, and public services crumble. By the spring of 2010, Greece was forced to accept its first bailout, a €110 billion package from the EU and the IMF. But that lifeline came with brutal terms. Greece had to do whatever it took to pay back their debt. 1 in 4 public workers were fired, while those who remained faced pay cuts of up to 30%. The public healthcare budget was slashed by 25% overnight, leaving thousands of sick Greeks without access to treatment. At the same time, taxes kept rising and rising. But that still wasn't enough. Greece needed to find more money, and fast. In desperation, the government turned to their last resort, privatizing public assets. Airports, oil refineries, waterworks, even the national power grid, the country's most valuable infrastructures, were being sold off. The port of Piraeus, one of the busiest in the Mediterranean, was handed over to a Chinese firm. Airports were leased to a German conglomerate, and the national power grid, a controlling stake, was sold to foreign investors. For ordinary Greeks, the message was clear. The country might still be called Greece, but it no longer felt like it belonged to them. To recover, Greece leaned into the only sector it had left: tourism. With over 6,000 islands and a coastline stretching nearly 14,000 kilometers, Greece has consistently ranked as one of the most beautiful countries in the world. And they went all in, upgrading their hotels, simplifying the visa process, and advertising the islands. At first, it worked. In 2009, fewer than 20 million people visited Greece, but that number quickly grew. By 2024, a record 41 million people poured into the country for tourism, an astonishing 200% increase. They bought cameras, wallets, and €22 billion worth of spending. Tourism now fuels over a quarter of Greece's entire GDP, and nearly 2 million Greeks earn their living from it. At the time, it seemed like the perfect remedy. On the news, sandy beaches and cruise ships replaced budget cuts and protests, and to the Greeks, it felt like hope had returned. But although tourism did create jobs, most of them were low-paying and seasonal. The average tourism worker earns only €1,100 a month, barely above minimum wage, while the average cost of living in a city sits at nearly €2,000. Meanwhile, neighborhoods began to shift. Places once home to teachers and shopkeepers were being transformed into hotels and short-term rentals. In Athens, working-class districts like Siri and Koukaki were overturned. Long-term renters were evicted, and landlords realized they could earn a year's rent in just a few weeks on Airbnb. Then in 2013, Greece decided to double down and introduced the Golden Visa program. Spend €250,000 on property and you get a 5-year residency. On paper, it sounded smart. Attract foreign investment and rebuild the economy. And attract foreign investment it did. Over the past decade, the program has brought in over €5.5 billion into the country's real estate market. It seemed like a blessing, like Greece had found a way out of their crisis. But beneath the surface lies a dangerous trade-off with permanent consequences. Most foreign investors didn't buy these houses to live in. They bought it for the visa and to make profit. Out of the 16,000 properties bought under the scheme, an astonishing 94% were repurposed into rentals. This shift meant that all the rental income from these properties was now flowing abroad. Year by year, profits that once circulated within Greece were now leaving the economy, and they weren't coming back. The money that could have been reinvested into local communities was instead being fed to investors thousands of miles away. But this was just the beginning. Things were about to get much worse. Thousands of homes were pulled from the market and converted into short-term tourist rentals. Entire apartment blocks gutted, renovated, and listed on Airbnb. In some neighborhoods, it became nearly impossible to find a lease that lasted more than a month. With houses constantly being taken out of circulation, supply became increasingly tight, and the pressure on the remaining housing stock exploded. The buyers were not couples or local families, but instead foreign millionaires, international real estate funds, and visa hunters with deep pockets. They weren't just buying property, they were buying leverage, and they were willing to pay for more than anything an ordinary Greek ever could. Demand spiked and prices surged. Between 2017 and today, residential property prices in central Athens have increased by over 88%. Rent has spiraled out of control, and for the average Greek, the average wages didn't come close. In fact, they were even falling. Many were now spending over half their income just to keep a roof over their heads. And even then, it still wasn't enough to stay. Before anyone could react, locals found themselves being priced out of their own childhood homes. It seems that they've now had enough, and every single year, thousands take to the streets, not to just protest against rising rent and falling wages, but to defend the very soul of their cities. By 2024, the backlash had grown too loud to ignore, and Prime Minister Mitsotakis finally stepped in. In an attempt to fix the market, new licenses for rentals were banned in central Athens, and the minimum threshold for the golden visa was increased to 500,000 euros in high-demand areas. But these actions just came a little too late. Much of the damage has already been done. Since 2009, more than 50,000 Greeks have been leaving the country each year. Many of them young, educated, and full of potential. Doctors, engineers, teachers, entrepreneurs. The very people Greece had invested in are gone. By today, over 500,000 healthy working-age Greeks have left. Those who chose to remain were forced to bear the consequences. With waves upon waves of healthy adults leaving the country, Greece's birth rate has collapsed to one of the lowest in the world. Only around 1.3 children per woman, compared to the global average of 2.27. But here's the part that not many people talk about. The crisis wasn't just caused by foreigners or tourists. Much of it was enabled, even engineered, by Greece's own political and economic elite. While millions of Greeks were tightening their belts, they saw the crisis as an opportunity to cash in. They didn't just survive the crisis, they thrived. When Greece was forced to sell off national assets to meet bailout terms, these elites were the first in line. They got public contracts and were the first to be bought in on privatized infrastructure. The same companies that helped run the country into debt were now profiting from its recovery. Ports, waterworks, and the power grid were all quietly snapped up by well-connected businessmen through partnerships with foreign investors. To them, it was the opportunity of a lifetime, and they took it. They were making heaps of money from basic human needs. A stretch of motorway in Athens infamously cost Greece 3 times more than to build a similar one in France, a country with double their minimum wage. The money clearly wasn't going to the workers, but in Greece that was just business as usual. And while all of this was happening, everyday wages persistently declined. Even in 2024, the minimum wage was just 830 euros a month before taxes. Rent alone takes up more than half of that. The truth stings. In Greece today, many tourists live better than the citizens themselves. In buzzing downtown Athens, upscale hotel rooms and luxury Airbnbs sit empty most of the year, yet demand keeps them spruced and staffed. Meanwhile, Greek families crowd into half-finished basements or split small apartments on the city's edge, scraping to make rent. Greece's story today serves as a reminder of how an entire country can crumble under its own irresponsible economic policies, warning others not to follow in its footsteps. But this isn't just about numbers or policies, it's about people. It's the teacher who now works 2 jobs to barely make a living. The young couple who gave up on starting a family because rent swallows up most of their paychecks. The people who had to move away and search for a better life elsewhere. The question is no longer whether Greece can be saved, it's whether the people who once called it home will still recognize it when they return, or if they will return at all.